Hello and welcome to this session in which we will discuss the timing of income and deduction. The timing of income and deduction is part of the tax planning strategy. And understanding the timing of income and deduction means what? It means when do you recognize, when do you report the income on the tax for tax purposes? Therefore, when you report it, it's taxable. And when do you record the expenses, which is going to give you a savings? And that's crucial for optimizing the taxpayer after tax wealth. Why? Because what we care about is after the tax, what is the net effect after the tax? This tax planning strategies also involve using the principle of the time value of money. So before we start the session, I'm assuming you are familiar with the time value of money in order to assess the impact of the tax-related decision, because the income and the deduction might be in future years. We have to assess, we have to determine what is the impact of time value of money on these decisions. So the assumption is you know the time value of money. If not, go to my time value of money lectures at farhatlectures.com in order to understand this concept. Let's go ahead and get started in discussing timing of income and deductions. Before we proceed any further, I have a public announcement about my company, farhatlectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. There are two core strategies in the context of tax planning when it comes to timing of income and deduction. The first one is you want to defer taxable income. What does defer mean? Defer mean postpone. What does postpone mean? It's move into the future as much as possible. Postpone income into the future period. Future period means what? Not this year. Move the income to future years. By doing so, you can delay paying taxes. And by doing so, the time value of money is higher for you because you are not paying now, you will be paying later. There's a time value effect. For example, an individual might choose to receive a bonus in January of the following year rather than December, pushing the tax liability for next year. What does that mean? Let's look at 2 years. Year 1 and year 2. This is year 1 and this is year 2. And if the individual has the option to record the bonus, to receive the bonus at the end of year 1 or at the beginning of year 2, they should choose year 2. Why? Because at the end of year 1, they'll have to pay the tax for year 1 sometime in year 2. However, if they choose to receive it in January of year 2, they will not have to pay the taxes on this until year 3. Therefore, they defer the payment, and as a result, having the money longer there's a time value to the money. You are saving on that. This strategy is beneficial if the taxpayer expect to be in the same or lower tax bracket. Of course, when do we defer the income? When we know we're going to be either in the same, we're going to have tax savings from the time value of money. If the tax bracket is lower, that's even better. It means we're going to pay less taxes because the tax bracket is lower for that particular income. So that's the strategy generally for income. What do we want to do? We want to defer income as long as the future year's tax rate is either the same or lower. How about expenses? When we have expenses, we want to take the expenses as early as possible. What does that mean? It means accelerate tax deduction, accelerate the expenses. This involves bringing forward any deduction to the current year. Why? Because you want to take advantage of the deduction now. It's worth more now if you take the deduction. For example, a taxpayer may pay for deductible expenses like a charitable donation or business expenses before year end. Why? Because if they want to take them in that year, assuming they are cash basis. This strategy would reduce the taxable basis now in the current year, leading to immediate tax savings. You want to take the tax savings as soon as possible. Now bear in mind, the tax landscape is dynamic. What does that mean? There are always changing in tax laws and personal circumstances. So such changes if there's any changes in law or personal circumstances, they can alter the effectiveness of the above strategies. Those are general strategies. Eventually, as we discuss different revenue recognition method, as we discuss retirement planning, we would look at each method separately, but those are the general rule. For example, generally speaking, if the tax rate are expected to increase, deferring income would result in future taxes. We don't want this. If we know the tax rate in the future are going to go up, we want to have the revenue now, we pay less taxes, well, assuming the time value of money. Conversely, if the rate are expected to decrease, what we do is we want to defer the revenue until later because we can pay less taxes into the future. Again, taking into account the time value of money. Don't worry, we're going to work examples to illustrate everything we are discussing here. What other factors influence tax planning? Well, we have to look at the comprehensive picture of the taxpayer, not just the tax rate. It's not just about deferring income or accelerating deduction, but also looking at personal situation. We have to consider all relevant factors. And we're going to look at some relevant factors that you want to keep in mind as you are doing tax planning. One is the different type of income we are dealing with. Salaries are taxed differently than dividend. They are taxed differently than capital gains. We have short-term capital gains, long-term capital gains. So we have to understand what type of income are we dealing with. That's important. So it's not all income is the same. Understanding how each income type is taxed can also influence our decision. Of course, changing the tax rate, we talked about this. Generally speaking, if you have revenue and future tax rate is increasing, you don't want to defer your revenue. If you have expenses and you want to take them now if possible, and we're going to see later that in some circumstances you want to defer them, and we're going to see under what circumstances. Anticipating future tax rate is crucial, but that's playing the guessing game. Type of entity. What type of entity are you dealing with? Individuals are taxed differently maybe than corporations. Partnerships are taxed differently than corporation. What I mean by tax, it means the tax effect is different. The income is not the same. This affects how income and deduction are recognized and taxed. So if you're individual versus partnership versus corporation. Also your filing status. You might be single now, in the future you might be married, filing jointly. You might be married, filing jointly now, and next year you might be married, filing separately. So you have to take into account the filing status of the taxpayer as well. So it's not one thing you have to look at the big picture. So changing and filing status can also influence tax planning strategy. Now, the best way to illustrate the general idea is to look at few examples with numbers to see how all this fits together. Let's assume we have Alex, a software engineer. In 20x3, Alex's tax rate was 25%. In 20x4, tax rate will be 30%, so the following year. Income for this year is $100,000. Year-end bonus is $20,000. Can be received in December 20x3, or Alex can defer it till January x4. Well, good. Alex also can take a deduction in either in 20x3 or 20x4. So let's think about this as a charitable contribution. He can make it in 20x3 or he can make it in 20x4. Okay. What should they do? What should he do? He should defer receiving the bonus in till January till 20x4 instead of receiving it in 20x3. Why? Because if we look here, the tax rate is going up. Even if the tax rate is the same, he should defer it. But since the tax rate is going up, definitely the income should be deferred. And accelerate the deduction. Paying the $10,000 expenses in 20x3 will be better because you get the deduction now. Now, the tax impact. Let's look at the numbers. Without planning, so it means without planning, he's going to get $120,000 between the bonus and the deduction minus the deduction plus the salary. So this is going to be salary plus bonus minus the deduction, 120. So the tax will be $30,000. With planning, if he will defer the bonus and only use the deduction, so salaries minus the deduction, his taxable income will be 90 and his taxes will be 22,500. So in 20x3 with proper planning, Alex will save 7,500. In 20x4 without proper planning, he's going to have 90,000 because he's going to take the bonus and the deduction in 20x4, salary minus the deduction, his taxes will be 27. With proper planning, so if he took the salary plus the bonus minus the deduction in 20x4, his taxes will be 33. So the difference between those is 6,000. So notice, overall, with proper planning, the net effect is a positive 1,500. And you might be saying, is it worth all this work for 1,500? Now, we're talking about small numbers. Assuming this individual adds zeros, and you might have 1.5 million of savings or 1.5 billion in savings for large taxpayer. So it's, yes, it is important on the timing of income and expenses. By deferring the bonus and accelerating the deduction, Alex saves 7,500 in X3 but pays 6,000 more in X4. The net savings is 1,500. So it just shows you the timing decision considering tax rate changes. Let's take a look at another example specifically for revenue. Let's assume we have a taxpayer, Max, the owner of a consulting business, and decided whether to finalize a large contract worth 50,000 on December 31st or keep that contract until year 1 of the following year. The tax rate this year is 28 and next year is 28. Generally speaking, without even going any further, what you would say, generally speaking, you want to defer the revenue. But let's look at numbers. The after-tax return on investment is 8%, which is the present value for the present value analysis. The present value factor, we're going to say it's 0.926. This is the present value factor. Again, if you don't know what the present value is, please go to Farhat lectures and look at the present value lessons in order to learn this. Option. So option 1, finalize the contract December 31st. Option B, finalize the contract January 1st. Let's see the effect on the bottom line. Year 1, income of 50,000. 28% will be paid in taxes. Therefore, he will pay 14,000 in taxes. What's the net effect after the tax? Well, there's no time value in year 1 because it's in year 1. Therefore, the 14,000 times 1, the factor is 1. That's 14,000. So income after tax is 50,000 minus 14. It will be 36,000. So the income after tax is 36,000 under A, under option A. What's option A? Sign the contract in the current year. Option B is defer the income for next year. Next year, again, the rate will be 28%. So what difference does it make here? Well, here's what it makes a difference. It's the present value of money, the discount rate, because what we care about is what is the net savings taken into account the discount. Yes, next year he's going to have to pay 14,000, but he doesn't have to pay it until next year. So what do? We compute the present value of this amount. Well, the factor is 0.926. So the present value of this amount, so next year, although he's sending a check for 14,000, the present value of this amount is 12,964. So simply put, what Alex can do, he can take 12,964, let it grow at 8%, 0.08 or 8%, and it will grow to 14,000. So all what he have to do as far as his expenses, net present value of tax is 12,000. Yes, he will be signing a check for 14,000, but that's next year. There's a time value, and the time value is worth the difference between those two. Whatever the difference is, this is the time value factor. So income after tax, if he takes option B, is his income after tax is $37,036. Why? Because if he pays the 14,000 now, it's worth 14,000. If he paid the 14,000 a year from now, it's only worth 12,964 because we discounted the 14,000 at 8%. Therefore, his income after tax is 37,000. Obviously, clearly as a result, 37,000 is better. Option B, the present value of the tax payment is lower due to the delay in payment. Although the nominal tax rate and the tax amount are the same. It's 28% for year 1, 28% for year 2. The check that he's going to have to sign also for 14,000. But delaying the payment will give us what? A tax saving. So for Max, finalizing the contract January 1st is more advantageous. His gain an additional $1,036, which is the difference between 14,000 paid today and 14,000 paid a year from now. They're worth today 12,964. And so this example demonstrates the factor, the time value factor in financial planning. Now we're going to keep the same example. So we're going to have the same fact but change the scenarios a little bit. So let's take a look at this scenario. This scenario, the tax for year 2 is 34,000. So Max now, same scenario, 50,000 can sign the contract January 1st or they can defer it till year 2, which is year 4. What should he do? Well, you already know the first option, option A, is 36,000. We already did this computation. Let's do computation B. So under computation B, $34,000. His taxes will be $17,000. But again, he's going to have to pay $17,000 a year from now. We have to find the present value. The present value of it is $15,574. So here's what happened. Tax rate went up, and the time value of money did not save you enough. Therefore, which option should we take now? Well, obviously, option A is better, because option A is how much? 50 minus 14 is 36,000. Option B, 50 minus the present value of 17,000, which is 15,742, is 34,258. Therefore, Max is better off signing the contract in December in that particular year. So year 1 is 36,000, year 2 34,258. In this scenario, the tax rate in year 2 makes option 2 less favorable. Well, generally speaking, it is less favorable. Now, but also it doesn't mean it's always less favorable. For example, if maybe you want to do an analysis where the tax rate is 30% and see if it's better or not. But generally speaking, once the tax rate is up, remember, if the tax rate is going up, we have to take into account which one is better. Is it to take the deduction, pay the taxes now, or pay it later? What we can conclude here is, in this scenario, finalizing the contract in year 1, which is option A, is more advantageous because of the immediate tax liability is lower in year 1 than deferring that in year 2. Even though taking into account the time value of money, it's not going to save us enough to be worth it to defer it to year 2. Let's take a look at a third scenario, and hopefully you know the answer for this third scenario real quick, and hopefully you get the gist. Same scenario, except year 2, the tax rate is 24%. What should you do? Definitely you would say, I want to defer it. Here you have double savings. The tax rate is going down, plus you have the time value of money savings. So you have two things working in your favor. Let's go through the computation. So the tax amount is $12,000, but you have to pay it a year from now. Discount this to the present value, it's only $11,112. Therefore, the after tax income is $38,888 versus again $36,000 the original scenario. Here you have the double benefit. Definitely you want to defer the income, and this is what you want. You want the tax rate to go down, the time value to give you some savings. Let's take a look now, rather than looking at revenues where you have future revenues, let's look if you have a future deduction, future expenses. Well, Sam, an owner of a graphic design company, is debating whether they should buy a new computer equipment for $15,000 this year or next year. What's the scenario? Both years will have a 30% tax rate. So the tax rate is the same. Given everything else is equal, when should Sam buy this equipment, now or next year? I hope you know they should buy it this year to get the deduction now. The deduction is worth now, then it's worth later, because when you take the deduction later, you have to discount it to the present. But let's go through the computation. So assuming the present value factor we're using is a 7%, and the factor is 0.935 for 1 year. Option 1 is purchase this year. Option B, or option 2, is purchasing the equipment next year. Let's perform the computation. If you purchase it this year, you'll get immediately a tax saving of $4,500. So your cost for this equipment after the tax saving, because you're buying it now, the factor is 1. 1 means there's no time value because you're getting the savings now. The after tax cost of this equipment is $10,500. So yes, we're going to pay for it 15, and this 15,000 would reduce our taxable income by 15, increase our tax savings by 4,500, which is 30% times 15,000. And there's no time value of money. Our cost after the savings after the tax saving is 10,500. Let's see what would happen if we defer this purchase until year 2, where we get the savings in year 2. Yes, the savings will be 4,500, but we will not get the savings until what? Until 2 years from now, until a year from now. Therefore, we have to discount the savings at the discount rate of 0.935. Therefore, if we take 4,500, the savings will be a year from now, so the year from now. So the savings net of the time value, or the present value of the savings, is $4,207. Not good. We don't want to defer it. Therefore, the after tax cost is $10,792 versus $10,500 the cost. We want to take the $10,500 cost. Remember, if you are dealing with a revenue versus an expense. So option A result in an after-tax cost of $10,500. Option B, $10,792. Again, this is cost, not revenue. If we're talking about revenue, it will be the opposite. So what do we do here? The immediate tax savings is more favorable in option A than option B. Okay, because the present value of tax saving is greater. Option A, there is no time value. You're getting the savings now. That's why it's 1. Conclusion, for Sam, purchasing the equipment this year, which is option 1, is more financially advantageous. Why? Because the tax saving is realized now. In this example, demonstrate how timing of significant expenses can impact the cost when tax consideration and the time value of money are taken into account. Let's take a look at this last scenario. Same exact example, except in year 2, your taxes are gonna go up substantially to 39%. Not your taxes, your tax rate. So now same scenario. Let's take a look now at what would Sam do. When would he buy this equipment? The tax deduction is $15,000. Now the deduction is worth $5,850. Okay, now we're gonna have to discount it at the present value. If we discount it at the present value at 0.935, it's worth $5,468. Still, $5,468, still more than $4,500. So what happened here is, well, didn't you tell me that I should not defer the expenses? Well, under these circumstances, since my tax rate going up substantially, my marginal tax rate to be specific, because you have to look at your marginal tax rate, I'm willing to defer the expense. Why? Because now I'm going to pay $15,000. My savings, taken into account the time value of money, is $5,468, more than $4,500. My after-tax cost is $9,531. So option A, your cost is $10,500. Option B, your cost is $9,531. So in this scenario, the tax rate, the increase in tax rate in year 2 make option B more favorable to defer the expense. So the higher the tax rate leads to a greater saving for the equipment purchase, outweighing the impact of the time value of money. So the rate went up substantially that it outweigh the time value. So the combination of a higher tax rate and the result in tax saving in year 2, as we mentioned, outweigh the present value advantage of making the purchase in year 1. So you always have to take into account all factors. Let's take a look at this multiple choice questions from farhatlectures.com. In the context of tax planning, what does the time value of money principle imply? What does it imply? Well, money received sooner is worth more than the money of the same amount received later. Is this the time value of money? So simply put, what we're saying, $1 today is worth more than $1 in the future, and the answer is yes, precisely. If you can get $1 today, it's worth more than $1 in the future. B, future money is always more valuable than present value. Not necessary. Future money is not always more valuable than the present value. You have to take into account how much that future money compared to the present value giving. For example, if you say, if I gave you, it's $1.05, it may not be worth it because the future value is 5% higher. Is it worth it or not? It may not be worth it. B is out. And the word always is tricky. Tax rate, we can say, the correct statement will be the future money is always more than the present money. Yes, if we take interest into account, but it doesn't mean it's more valuable. It doesn't mean it's more valuable. For example, if you told me if you're gonna get $1 today or $2 in the future, then yes, maybe it's more valuable because you're doubling your money. But if it's 105, it may not be worth it. Tax rate will remain constant over time. No, that's not true. That's not what the time value of money principle. Investing money is not beneficial. No, that's not true. Investing money is not beneficial. Therefore, the time value of money, the money received sooner is better, is worth more than the money received later, the same amount of money. The sooner you could receive the money, the better off you are, because the time value of money factor. What should you do now? You're going to go to Farhat lectures and look at additional MCQs that's going to help you with your CPA exam preparation, as well as your accounting courses, tax courses, or any professional certification you are taking. Study hard, good luck. Your education is worth it, and stay safe.